Welcome to Market Moves. My name is Vincent Scarsella, Director of Research here at Sgroi Financial, and we will be looking at what has happened in the previous quarter and where we see opportunities lying ahead in the coming months. The S&P 500 took a breather in the third quarter of 2023 as Powell's hawkish FOMC speech sent markets reeling a touch. He said two things that the markets really did not like. The first being that interest rates will have to stay higher for longer to combat still high inflation here in the United States. The second being that we could see another potential rate hike here in the US before year end. With that being said, we still have seen strong gains here in the US year to date. The S&P 500 is still up over 13%, with the tech-heavy NASDAQ still up over 27%, and the Dow Jones Industrial Average lagging its counterparts up 2.73%. A very interesting thing that has happened this year is that the majority of the returns for the S&P 500 have been driven by what are being dubbed as the Magnificent Seven, or the top 7 stocks in the S&P 500. They have a total return of 84% for the year, whereas looking at the equally weighted version of the S&P 500, that is only up 1.8% for the year. So we have seen a massive divergence in those top 7 mega tech stocks in the S&P 500 versus the rest of the index. Now, diving into the sector performance for the year, as we have seen throughout financial media, the AI boom is real and alive. And with that, the technology sector is up over 32.5% this year. Now, diving into sector performance, communication services is up over 37.5% for the year. And the primary driver for that is Meta and Alphabet, which make up over 46% of the index, are up over 150% and 49% respectively. Following closely behind the communication services sector, the technology sector is up over 32.5% for the year, as investors have continued to flock to those mega cap technology stocks. Following behind the tech sector, the consumer discretionary sector is up over 25.5% for the year, as investors have bet on the consumer still strong and wanting to purchase big ticket items from the pent-up demand from the COVID lockdowns. Moving to economic data, Treasury yields have moved up across the curve. The main driver behind this has been that as Powell has been so stern on bringing down inflation, investors have had to move out potential rate cuts for 2024. This in turn has affected the fixed income market as a whole, as yields and prices of bonds are inversely correlated. So then as yields start to rise, bond prices start to fall. Moving now to what we're seeing in the months ahead, there are 3 key things that investors will be focused on: inflation, US economic growth, and the Federal Reserve. Inflation has come down this year, but it could prove stickier than anticipated. When we are comparing it to the unsustainable levels of 2022, it is not hard to see inflation start to come down. Now, the comps do get tougher in the months ahead. With rising oil and commodity prices, the prospect of a bounce back in inflation is real and will be watched intensely by market participants. Now shifting towards US growth, just like inflation, the easy part is behind us. Excess savings here in the US are likely depleted, and with each passing month, higher rates are taking a bite out of the economy more and more. If we see any signs of US economic growth slowing here in the US, market participants will be looking at that very critically, which could then cause more volatility, especially in Q4. Finally, shifting to the Fed has shown all year that they will be reactionary with the data. All through 2023, market participants have been betting on what is called a soft landing, whereas the Fed raises rates just enough to cool the economy and not to send it to a downturn. We have seen conflicting data throughout the year. We have seen soft landing data. We have also seen hard landing data. Hard landing is where the Fed raises rates too much, which causes a severe downturn in the US economy. Market participants now will be looking at Q4 data very, very intensely then to see whether we can tilt towards that soft landing narrative or more towards that hard landing narrative, which will then be very important for 2024. So the key for this market will be to identify if any long-term risks are materializing, because if that is the case, that will be the time to get more defensive. In our portfolios here at Sgroi Financial, it is hard to understate how constructive we have become on the fixed income market. With yields starting at historically higher levels than before, and bonds having 2 return components, that is price appreciation and total return. This is why we still prefer bonds in our models, as they offer diversification benefits from the equity markets and still act as a hedge to any stock market shocks that we could see. On the equity side, we are agnostic between value and growth, but do prefer the quality factor. Quality stocks have strong balance sheets and cash on hand to weather any potential downturns that we could see. In closing, please do not hesitate to reach out to us here at Sgroi Financial, and we will see you in Q1 2024.